Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. I'm very pleased to say the Chair of the White House Council of Economic Advisers, Stephen Miran. Mr. Chairman, welcome to the programme, sir. A warm welcome to Bloomberg Surveillance. I've got to ask you the number one question on the lips of a lot of people on Wall Street at the moment. Is this a negotiation or the new rules of the game? How would you frame things for people this morning?
Good morning, and thanks for having me. How I'd frame things is that it could be either. I think the president is famous for his negotiating skills. The president is renowned for pulling deals out of a hat when nobody thought it was even possible. I'd remind everyone that the Phase 1 China deal in 2019 was a fantastic deal for the United States that the president created. It covered intellectual property, it covered market access, it covered purchases of agricultural commodities, it covered currency manipulation, it covered all sorts of things, and it was a fantastic deal. And unfortunately, the Biden administration walked away from it and refused to enforce it, and that was a big loss for America. So the president is famous for being able to create deals when nobody thinks he can, and so that's what it can turn into if other countries come and offer the right things that persuade the president.
Well, let's talk about the right things. So as far as we know, Vietnam came to the table and offered to drop their tariffs to zero. That was rejected. The EU offered to drop tariffs on industrial goods. That's been rejected. What would be the right kind of offer? Are they aware of what the right kind of offer would be?
Right. So I think that a narrow focus on tariff rates is insufficient, because the truth is that the non-tariff barriers pose enormous barriers to trade balancing over the long run. Countries have to open their markets to U.S. exports, and I don't know exactly what combination of details they have to make in an offer. But all I can say is that negotiating is better than not negotiating.
Stephen, the difficulty that people are having at the moment, and you're aware of this, I'm sure, is that they're unclear whether it's about barriers to entry or just the deficit, because they are two different things. Which one is it?
Of course they're two different things, but they're deeply related and inextricably related. If you reduce your barriers to entry, you open your market to U.S. exports, of course the trade deficit will respond to that. I think that there's no question about that.
When you talked about yesterday, I know you gave a speech, you talked about this way of burden sharing and some other measures partners could take to potentially get to a deal. Things like even writing checks to the Treasury. How exactly would that work?
Well, I think there's a variety of ways that could work. For one thing, they could just, sort of simply say, hey, America is providing us with, with a defense umbrella which creates prosperity, which creates peace, which allows us to prosper economically. They could say, hey, America is creating a global trading system backed by this defense umbrella, which again allows us to trade, which creates our prosperity, and we're going to help share the cost of those things. We're going to send some money to the United States to help it provide those things. I think that would be a fruitful outcome. But of course, it depends on what the president decides. The president will negotiate the deals that he thinks are best for America, best for Americans, and I can't get ahead of him on those issues.
You also talked about how partners can invest in and install factories in America, or trading partners. Could China do that?
I think they could, but it remains to be seen whether they'd be willing to. I think China's policy has been to try and sort of steal all the manufacturing market share for themselves, not only from the United States but for many of our trading partners as well. And it seems to me unlikely that China would be willing to make that concession up front. However, I would welcome it.
So China said yesterday they will withdraw. Trump said yesterday, that if China does not withdraw the retaliatory tariffs, the U.S. will impose an additional 50%, less than 24 hours, starting tomorrow. Do you expect those additional 50% tariffs to come into play?
I think that depends on the Chinese, and my advice to them would be that they have a lot more to lose than America does. That America holds the leverage, and everybody knows that, and therefore they should seek a détente, and they should offer concessions which would persuade the president to relent.
Uncertainty might be a good negotiating tactic, but it's really bad for business. That's been the message from a lot of corporate executives, and what you're seeing certainly in markets. Are you worried that U.S. companies are going to stop investing and that could stymie some of the progress that you're hoping to engineer?
Yeah, so the president has been very clear that what he's engaging in is a long-term improvement in the economic welfare of the United States and a long-term improvement in putting American workers on fairer ground vis-a-vis the rest of the world. Some temporary uncertainty will come along with the transition and with the imposition of those policies. That's without a question. However, I think it's important to understand that uncertainty doesn't really cause recessions. I don't think that there's been a recession that was caused by people wondering, what's going to happen tomorrow. Uncertainty can delay decisions, for sure. As you're saying, there could be some transfer of investment decisions, some transfer of hiring decisions from one month to another. That's absolutely possible. But there's limits to that because eventually a firm is going to decide, hey, I really need to add this capacity, or hey, I really need to make a decision about what's going on. And at some point, waiting becomes not worth it. So is there a chance that the uncertainty causes, sort of distortions in the month-to-month or quarter-to-quarter macroeconomic data that make one quarter look weaker and another quarter look stronger? Absolutely. That's likely, right? If it's not only possible, it's quite likely. But companies can't delay decisions forever. Eventually, they got to pull the trigger and they got to invest based on their evaluation of the most likely policy landscape in the future. And the president has been very clear about what that policy landscape looks like. In fairness, though,
a lot of people, in particular Wall Street economists, have come out and said actually uncertainty can cause a recession. And we have heard that from a number of different Wall Street firms, from a number of different companies, and frankly, the Small Business Consumer Survey came out this morning and saw the steepest plunge that we've seen going back years. There is a question here about, yes, they have to ultimately make decisions, but when do they start laying people off? At what point are you worried about execution risk at a time where some of the structural changes take a lot longer than some of these policies are taking to implement?
Yeah, well, look, there isn't really any material sign of layoffs in the macroeconomic data, so that's not something that I'm seeing right now at all. And what I would say is, again, to remind people that there are three legs to the stool. One is trade renegotiation. The other two are deregulation and tax reform, and those are still in the pipeline. We're waiting on Congress to extend the president's historic tax cuts from 2017, which will sort of preserve low marginal rates in American workers and firms. But on top of that, what we experienced in Liberation Day was a roughly 13 percentage point rise in the effective tariff rate on all imports, and that's going to create enormous amounts of revenue, hundreds of billions of dollars of revenue that can be used to provide additional tax relief for Americans. And the president has been pretty clear laying out certain forms of the tax relief, and I think that there's scope to go even further than that. I personally would like to. However, it depends on what Congress works out and negotiates with the president on that. I don't always get, I'm not the president, right? The president is the one who will decide in collaboration with Congress. But I think that using that revenue for additional tax relief would be a fantastic outcome. I think that deregulation is underway, and that the combination of making America more competitive via tariffs with making it easier to build and invest and hire here is a fantastic outcome. And when you look ahead to the future, there's going to be an America that's the best place in the world to do business, because the tariffs make it competitive, deregulation makes it easy, and tax reform makes it efficient. And tax reform keeps more money in people's pockets, makes it easier to hire, easier to invest, and those are all great things. And the markets will look forward to that. Markets should be forward-looking. Yeah.
You're talking about the entire policy proposal. Markets are forward-looking. They're already pricing in just that, the extension of TCJA. What more can be done on the tax side? Do you think we will get no tax on tip, no tax on Social Security?
Yeah, I think we'll see that. And I can't get ahead of Congress. I can't get ahead of the president, but the president's been clear in calling for those things, and I'm optimistic that we'll get them. And I'm also optimistic that we'll get some form of further tax relief beyond that. What form that takes, will be up to Congress and the president. But I think that it would be a fantastic outcome for American workers if we took money raised by tariffs levied from foreigners and used that to lower taxes on Americans. That would create a more efficient, dynamic, competitive economy that would transition into the president's new golden age.
Stephen, how can it be both? How can it be both a source of revenue to provide tax relief and an option for negotiations?
Well, tariffs raise revenue, and then
I've got
from
that
that
piece
revenue...
of it. Yeah, sure. But you said you can negotiate this.
Oh, because the negotiation. Okay, so yes, so I understand what you're saying. So presumably, if the negotiations lead to materially better trade terms for American firms, then you create a booming economy because there's much more demand for our exports.
And then we take the tax relief back.
well, then you don't have this additional revenue to pay for that tax relief. But nevertheless, Congress and the president are determined to extend the original tax cuts and provide the additional relief that the president has spoken about.
Okay.
So it's a question of how much further beyond that can you go?
We'll keep struggling to make sense of it. We appreciate your help this morning. Stephen Miran there, the White House Council of Economic Advisors Chair. We begin this hour with stocks pushing higher as markets look for signs of policy clarity. Julian Emanuel of Evercore cutting his year-end price target on the S&P to 5,600 from 68, writing the following. Prolonged uncertainty has raised asset volatility, damaged confidence and increased the odds soft data eventually infects the hard, causing stagflation or outright recession. Julian joins us now for more. Julian, good morning.
Good morning.
Why are you so bullish? Even with the price target cut. Based on what we've seen over the last few days, where does the bullishness come from?
The bullishness comes from an expectation that if we look at the last couple of weeks, we have arrived at the point of maximum uncertainty, okay? And it's like whether you think about it in terms of market volatility, uncertainty measures, frankly, tariff rates, which is the crux of where the uncertainty is from. All these things really aren't sustainable in the long term because what ends up happening is you get the recession scenario. And I think as an investor, you have to believe a couple of things here. You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession because, frankly, precipitating a recession has a lot of other knock-on unintended consequences.
None of us can get into the minds of the president. I've got no idea what he's thinking this morning, going ahead to the tariffs that will kick in overnight. Can we touch on valuations? What's the forward multiple on the S&P right now?
It's well over 20 still.
Does that speak to maximum uncertainty?
It does not, okay, but we have maintained this for 2 years now, and it's certainly worked reasonably well over the last 2 years, is that valuation alone doesn't end a market cycle, okay? What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher. And if we think about the last couple weeks, look, there have been two significant wins here. Number one, oil prices are a lot lower than I think any one of us would have expected,
Agreed.
Given the fact that Russia and Ukraine is still in escalation mode, and the Middle East is still in escalation mode for the most part. And bond yields have also come in.
You went through three things, and I was just thinking tick, tick, tick. Fed's showing no willingness to step in. Yesterday, bond yields were higher. What's the circuit breaker for?
So you have to differentiate between a Fed willingness to step in and a Fed who's going to say inflation, which now, in our view, is in the mid-threes for 2025. I don't think he's going to remove the word transitory because, and our research shows that essentially the real threat is less inflation. It's the one-time hit from wherever we go, and our operating view is that tariffs will actually settle in around 15 to 16% on a global weighted basis, call it by the end of the third quarter. That's how investors can live with it going forward, but that the real threat is the new tariff regime slowing growth perhaps even more.
Is it overly complacent to view this as just business as usual, to not really consider a structural change that frankly is the goal of this administration that could potentially reorder trade and potentially cause a decoupling between the U.S. and China?
Well, again, in 80 days, you're trying to remake a global trading system that took 80 years to build. So to call it business as usual, would be someone who perhaps didn't take defensive measures to his or her portfolio in the last number of weeks. And the question is, are we going to get, and I think Secretary Bessent was right and proper in making the point that there needs to be more singing from the same hymn sheet and an openness to cut deals.
One of the big concerns yesterday was what happened in the bond market. And we were talking about it. A lot of people called me. They said, what are you hearing about this? People didn't have an understanding, but it spooked people that you saw the biggest sell-off in 30-year bonds going back to the pandemic. And why? I don't know. Maybe because of disruption, maybe because of basis trades, maybe because of foreign selling. At what point does that type of disruption fundamentally spook you? And frankly, your bullish call for gains by the end of the year?
Well, actually, at this level of yields, perfectly reasonable. Now, again, remember, part of what we're saying is that asset price volatility all over the place is much larger. So if we're ranging between 390 and 430 or 440 or so in the 10-year yield, that's okay. We live with the volatility, but on balance, that is a rate for forward discounting of share price multiples that we can live with. It's the question is what was behind yesterday's selling. We don't buy into the fact that it was international investors dumping bonds. We buy into the fact that logically, if you think about it, given the moves that we've had in the last several weeks, it's asset allocation.
But to me, the idea that one headline could drive $2.5 trillion of value destruction and creation over, again, just a blip, that's emerging market-like trading. That is not the deepest, most liquid market in the country, in the world. That is not what we're used to, and that is not the reason why people go to the United States on a risk-adjusted basis. That completely undermines the whole premise of the U.S. market. Why does that not shake your confidence that there can be the same kind of dynamic going forward of some sort of American market exceptionalism?
No, you're absolutely right about that, Lisa, and that drives home the point that we have to have, I wouldn't necessarily call it off-ramps, but we have to understand what the path forward could look like to be able to deal with and make assumptions and make capital allocation decisions, whether you're an investor or a corporate, and that's why the emerging policy has to have a direction of travel to where we've maxed out on uncertainty, we've maxed out on potential tariffs, and we are going to get in the art of the deal mode. That's why, again, given this incredible volatility that we've seen in asset markets, which does undermine confidence, the month of April is as important as it is to sort of subdue the feeling in markets. And to the good, we would say, if you look at it, the bearish sentiment is as intense as I've ever seen it, going back to the financial crisis in 2008. You look at the share volumes the last 2 days, off the charts record share volumes. That tends to happen closer to trend changes than trend continuations. So, it's almost getting to a point where it's so negative that at least there's a ray of sunlight.
You offered up a timeline. The end of the third quarter, you think tariff rates could come down anywhere between 10 to 16%. So basically for back to school. What about all the damage that could be done between different administration officials singing from different hymn sheets between now and the end of September?
Well, that's the critical issue. And again, that's why I think, Treasury Secretary Bessent is trying to get people to sort of come together on this. And to the extent that it does or it doesn't, it really will be reflected in asset prices. But, the shock that we've had to the system over the last month, and in particular the last week and a half, is such that you're in the zone where the sentiment data could materially infect the hard data. And to your point, in home selling season, which we're in the peak of right now, and then back to school, et cetera, that's where the economic risk lies.
Larry Fink told Eric Shatsky yesterday at the Economic Club in New York that the CEOs that he speaks to think we're already in a recession. I just wonder what we hear from the CEOs on Wall Street on Friday when the earnings come out. What do you think they're going to tell us?
I would think that Jamie Dimon will warn the way he has about policy implementation and uncertainty. And look, this is going to be an earnings season where, it's sort of similar to the unemployment report on Friday. It doesn't matter what the numbers are. It absolutely doesn't matter. What matters is the level of expressed uncertainty, and will companies pull their guidance? And I'm sure there are a few that will.
Yeah, Julian, it's good to see you. Thank you, sir. Thanks for dropping by. Julian Emanuel there of Evercore. Montgomery-Koning of Barclays writing, dollar negativity is now consensus and our sentiment index is in maximum bearish territory. Historically, this has been a fairly reliable reversal sign. Skylar joins us now for more. Skylar, historically, I just wonder how different this time might be.
Yeah, I mean, it's interesting because I think the reaction to tariffs was unexpected for the dollar. All else equal, we know that U.S. tariffs should boost the dollar. But I do think there's a logical explanation here in that, our import substitution model shows that dollar strength does occur on U.S. tariffs, but it also shows dollar weakness if all tariff countries respond in kind. Because in that situation, a larger share of U.S. exports would be tariffed than, say, Europe, which only has new tariffs on exports to the U.S. So this tells us that within FX, we're reliant on how the economies respond to U.S. tariffs. The second point has to do with growth and confidence. I think there's this growing concern over U.S. policy. From an economic perspective, tariffs are not wrong if there's an existing distortion. But sweeping tariffs with very little nuance are clearly suboptimal, and they raise recession odds. U.S. growth was already slowing with confidence under pressure. And the one clear conclusion from tariffs is that they are U.S. growth negative, whether they stay in place across the board or renegotiated in some places or not. On the other side, that means if there is also likely still some hope that there are deals, and we don't know where those deals would be yet. So I think that reflects some of why you have this dollar downside, but I think it's very hard to maintain an environment of slowing global growth.
Skylar, one thing we've discussed on this program repeatedly is not just the shock to the cycle, but the potential shock to the system. We'll catch up with Stephen Miran later, the chair of the Council of Economic Advisers at the White House, in about an hour from now. And one thing he said, particularly in the last 24 hours, is that the security umbrella that the United States has offered the world, together with reserve assets that facilitate trade, he's making the point that that's distorted the US dollar. There seems to be a pushback against the system. And is that something that we can fully internalize now? I don't think so. But in coming weeks and months, coming years, how are you thinking about those changes?
Yeah, I think because we have these great worries over U.S. policy, they have brought into question the role of the U.S., and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that in turn putting pressure on the dollar, we think it's too early to make that call. At minimum, I think for money to move to foreign markets, you need some kind of improved asset returns in these markets, which seems like a very high bar with global growth slowing. So for example, in China, margins are mid to high single digits. Tariffs on the scale the U.S. is imposing pretty much completely wipe that out, even if you pass a significant portion of that onto the consumer. For bonds, U.S. yields are still relatively attractive, while there still isn't a large liquid alternative market. This is also not the first time that the market has falsely gotten excited about this narrative, and it wasn't sustainable. We've had more than a decade of policy that's very much favored the U.S., and it's very hard to undo that. So I'll maybe just finish off by saying that, even if it is the start of a massive rotation, that's something that will take a decade or more to play out. So there's still time to position for it, and you don't need to take on the early signal in case it's false.
How do you get ahead of the idea that maybe China will allow the renminbi to weaken disproportionately to offset some of the damage that we're seeing or potentially increase their export power?
Yeah, I think that's kind of our base case in terms of China. One of the places that rhetoric on trade has been very clear. Tariffs have gone into place. They're very large in scale, and they've only escalated since Trump has been in office. Authorities in China have been artificially supporting the currency, so current tariff rates imply that dollar CNY should be much, much higher than current levels. And there is this view that they won't let the currency go because they're worried about capital flight. But capital flight will also leave if the growth outlook deteriorates significantly, even if you keep the currency steady. So when the economy deteriorates, they can either take the hit, moderate it via significant subsidies, or they can let the currency go. And they've been unwilling to do large-scale stimulus or enough, at least, to really prompt the consumer to spend again. So we think it's more likely that they do let the currency go, and in part to support their export market. And so we do like being long dollar CNY, and our target on that is around 750.
Skylar, there's this question about how Europe will respond, and we were talking about the haven status of the U.S. and just how fundamental it is to the overall system. In Europe, they are planning to do fiscal stimulus. There could potentially be other offsets, regardless of whether there's a deal struck. How do you calculate the fiscal impulse into at what point the euro could potentially strengthen in a more material way?
Yeah, so I think the euro in the last week or so, it's benefited from the fact that it's a liquid alternative to the dollar. It's more trading off of U.S. center negativity more than it's trading off of tariffs positives. And now there's this tug of war between tariffs and the fiscal response. And by that I mean we do expect U.S. tariffs to put the European economy into recession. That's definitely no. But we've already seen large-scale quantify that as you can look at fiscal, and around 1% of GDP in fiscal expansion is around 30 to 35 basis points. On the long end, you can then take the beta between yields and effects to find what kind of policy response feeds into euro dollar. So for us, we're very much waiting on what the size of that stimulus is to have an idea of where we think euro dollar fair value is. But you also need to consider there are other components, right? If CNY weakens materially, that will also put downward pressure on euro. So you need quite a big fiscal stimulus, I think, to offset the tariffs that we've seen, with one measure saying that, the fiscal that we got from Germany already adds around 40 basis points to European growth, but a 5% tariff takes away 40 basis points, and we're at 20%.
Hey, Skylar, we've got to leave it there. Appreciate your time. Skylar Montgomery-Koning there of Barclays. Thank you. Nancy Lazar of Piper Sandler seeing tariff-related inflation as a one-off and saying, quote, easing aggressively now would risk a sharp inflation reacceleration in 26. As of now, after the one-off tariff inflation hit to the economy in 25, inflation is likely to slow in 26. Nancy joins us now for more. Nancy, good morning.
Good morning.
Are you suggesting they just wait then?
I would prefer the Fed be more ease very, very slowly, because, again, what you don't want to do is repeat what we did in 2021, which was eased in a temporary shock and then create way too much liquidity, and inflation indeed comes back. I didn't like the fact he used the word transitory again.
Not many people did.
Nervous. Yeah.
JP Morgan Asset Management, Bob Michael, on the program with us on Sunday evening as we waited for equity futures to open on the S&P 500. He said maybe this Fed couldn't wait until the next meeting. The next meeting's the first week of May. Can they wait that long?
Oh, I would say, again, this is not an interest rate problem. In fact, the lagged effects of a Fed easing cycle are still going to help the economy once uncertainty can come down and these price shocks can fade. So the Fed has already eased. Let's not forget that. And as we move into the back half of the year, they could actually already help to support growth. So, yes, later rather than sooner would be healthier for the long-run inflation outlook.
What's the historic analog to now where we can get some sense of how inflation has behaved with tariffs at a time where potentially you could also see some sort of demand shock?
So you can go back to 2018, where you had two industries in particular that had big tariffs on them, both washing machines and furniture. And you saw an increase in price immediately, and then you had a decline in unit sales immediately. And then over the next year, you started to see prices actually decline because of that weakness and also the substitution effect. So again, it would be best for the Fed to be patient as we go through this price shock, see a dip in the economy, maybe 1% GDP growth as we move into the second and into the third quarter. And then by the back half, fourth quarter into 2026, you can see an incremental improvement in the economy. And the Fed doesn't have to do much to get that.
Some people would argue, including the likes of big Wall Street firms, and a number of Wall Street firms have predicted a base case now of recession, including JP Morgan. Why should the Fed look through that, given what the surveys are showing and given the fact that companies may come out and give some guidance other than Levi's, but may give some guidance to that effect?
Well, they may not look through it. They may incrementally ease. But again, the Fed has already eased. Our models were actually pretty optimistic for 2025, seeing a healing in the economy as we move through the year because of the easing cycle that we saw last year, lower bond yields that we have started to see. Now, oil prices are down. There are basic supports for the economy. This is a one-time price shock, and to ease too aggressively, again, risks creating this inflation next year.
Let's talk about those risks of it not being a one-time price shock.
Yep.
What are the sources of inflation that would concern you going forward from here?
Well, wage inflation actually has been very sticky over the past year. Even average hourly earnings have basically stopped slowing, even prior to the current environment, which told us that inflation was again sticky in 2024. And I think the Fed should heed that. And you've also seen it in some of the price measures, again, here in the first part of the year, where you've seen the ISM price measures increase pretty much across the board within the regional Fed measures. factors.
Neil Dusser's made a similar point from Renmark about the risk of second-round effects. He talks about the anxiety of the consumers right now, and you see it in the reports and the surveys. They're anxious about higher unemployment in the future, and if that's the case, the idea that they're going to go around and bid up their wages anytime soon is difficult to get your head around.
Which is a reason why a lot of people aren't looking to that kind of inflation. Are you arguing that potentially a Fed rate cut of even 50 basis points could engineer that confidence at a time where the shock isn't coming from elsewhere?
No, I don't think a Fed rate cut. I think the next major issue for the markets are going to be, one, what inflation does in say, April and May. You're going to get a price shock, a big price increase from the tariffs that are being put in place. We think CPI could accelerate to around a 5% quarter-to-quarter annualized run rate, and that's going to take consumer spending down, and we're watching our daily consumer confidence survey. So no, we think the Fed can ease. They just can't ease aggressively, and they've already been in an easing cycle. They've pulled back on QT, and so let's not get carried away, because there are longer-term supports for the economy as we come out of this, and which we hopefully is by the fourth quarter of this year.
A couple of weeks ago, people were talking about the sequencing of the policies coming out of this administration, that the difficult stuff came first, the tariffs, some of the negative growth shocks, and then the pro-growth shocks come later on with respect to tax cuts and deregulation and other aspects. How much are people overlooking that as a potential catalyst for some growth and, frankly, potentially even inflation, and discounting how much of an upward stimulus that could be on the economy?
Oh, I think that is a very, very significant point. I started in the summer of 1981, and it was chaos in the summer of 1981. Volcker wasn't sure if he was going to be successful. Reagan did similarly. He was going to take some pain near term, allowing Volcker to do what he wanted to do. He fired people. I'm not comparing Reagan to Trump, but I'm just suggesting it's not unusual for an administration to do that. And the longer-term positives are positives. To have onshoring, which I've been focused on for 15 years, is an incredible positive. There are people who want to work in factories. Clarity on the tax reform, deregulation, a smaller government. So there are some longer-term positives if we can potentially negotiate some with these tariffs. I'm also for free trade. I'm also for fair trade. And if we come out of this current turmoil with some fair trade, then yes, you can add that to the list of positives for 2020, 2025.
Nancy, I share that sentiment almost entirely. I'm pleased you said it. I think this has been a problem for a long, long time. It goes back decades. I think this administration, led by this president, has done a tremendous job of articulating that problem. The president's done it going all the way back to the 1980s. This is about whether this is the right policy executed in the right way to try and remedy this situation, Lisa. And I think they're two separate conversations. I think you've got to be able to acknowledge the former and then have a debate about the latter. And that's the struggle that a lot of people are seeming to have at the moment over the past week or so.
I'm so glad that you framed it that way, because I think a lot of people do agree that there are some issues, some problems that are very correctly identified by the administration. It's execution risk. It's this question of the uncertainty itself that does have a prolonged period of time, and how it is a key feature in the way that maybe these deals might be being negotiated or not, or maybe this is just simply policy, John.
Nancy, it's good to see you.
You too.
Thanks for dropping by. Thank you. Nancy Lazar there of Piper Sandler.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.